Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding credit spread risk in today's investment landscape. Credit default swaps, CDs. CDs are financial derivatives that function like insurance against the default of a borrower. They provide insight into the market's perception of credit risk. A wider CD spread indicates higher perceived risk, while a narrower spread suggests lower risk. Here's why they matter. Protection. They protect investors from the risk of default. Market sentiment. Changes in CD spreads reflect shifts in market sentiment about credit risk. Spread analysis. Spread analysis involves comparing the yield of corporate bonds with similar maturity government bonds. The difference in yields, known as the credit spread, helps measure credit risk. Key points to consider. Yield spread. A wider yield spread typically signals higher perceived credit risk. Historical trends. Looking at historical yield spreads can provide context for current spreads. Rating agency reports. Credit rating agencies like Moody's, S&P, and Fitch provide ratings that assess the creditworthiness of issuers. These ratings can be invaluable for understanding credit spread risk. Rating scale. Higher rated bonds, e.g., AAA, generally have lower spreads and lower risk. Lower rated bonds, e.g., BB, have higher spreads and higher risk. Downgrades. A downgrade in rating can lead to a widening of the credit spread. Case studies. Credit spread risk analysis. Examining real-world examples helps illustrate the impact of credit spread risk on investment outcomes. Here are a couple of notable case studies. 2008 financial crisis. During the 2008 financial crisis, credit spreads widened dramatically. Companies with lower credit ratings saw their spreads increase significantly, reflecting higher perceived risk. This had major impacts. Investment losses. Investors holding lower-rated bonds faced significant losses as the spreads widened, indicating increased default risk. Flight to quality. Investors moved towards safer assets like government bonds, widening the spreads even further. COVID-19 pandemic. The outbreak of COVID-19 in 2020 had a swift and severe impact on credit spreads. Initial shock. Credit spreads widened rapidly as market uncertainty peaked. Government intervention. Central bank actions, like the Federal Reserve's bond buying programs, helped narrow spreads by mid-2020. Sector impact. Some sectors, like airlines and hospitality, saw more significant spread widening due to higher risk of default. These tools, metrics, and real-world cases provide valuable insights into assessing credit spread risk. By understanding and applying these strategies, investors can better navigate the complexities of the credit market. Mitigating credit spread risk. When it comes to investing, managing credit spread risk is crucial. Nobody wants their investment to go south because the risk wasn't properly handled. So how can you protect your investments from this kind of risk? Below, we'll look into some practical strategies investors can use. Diversification techniques. Diversification is like having a safety net. By spreading your investments across various assets, you reduce the risk of any single investment hitting you hard. Think of it as not putting all your eggs in one basket. Here are some ways to diversify effectively. Industry diversification. Invest in different sectors. For example, mix tech stocks with healthcare and consumer goods. If one sector takes a hit, your entire portfolio won't crumble. Geographical diversification. Spread investments across various countries. This helps reduce the impact of regional economic downturns. Asset type diversification. Don't just stick to bonds. Include stocks, real estate, or commodities. Different asset types can react differently to market conditions. In short, diversification reduces the exposure to any single risk, including credit spread risk. Using derivatives for risk management. Derivatives can sound complex, but they're just financial tools that derive their value from an underlying asset. They can be quite handy for managing credit spread risk. Here's how derivatives can help. Credit default swaps, CDs. This is like insurance for your bonds. If the issuer defaults, the swap compensates you. It's a direct way to hedge against credit risk. Interest rate swaps. These can help manage the risk of fluctuating interest rates, which can affect bond prices and spreads. Options and futures. These contracts allow you to lock in prices and spreads, reducing the uncertainty in volatile markets. Using derivatives may involve some costs, but if used wisely, they can provide a robust defense against credit spread risk. Investors have several tools at their disposal to mitigate credit spread risk. By diversifying their portfolios and using derivatives carefully, they can help stabilize their investments and protect themselves from unexpected market swings. Understanding and managing credit spread risk is vital for any investor looking to make informed and smart financial decisions. Credit spreads can give you insight into the health of the economy and individual companies, acting as a valuable tool in your investment strategy. Key points recap. Let's quickly recap some of the key points discussed in this video. Definition and importance. Credit spread is the difference in yield between two bonds of similar maturity but different credit quality. Risk factors. Factors such as economic conditions, company performance, and interest rates can affect credit spreads. Measuring credit spread risk. Tools like credit default swaps and yield curves provide a better understanding of credit spread risk. Investment strategies. Techniques like diversification and credit spread trades can help you manage this type of risk. Why managing credit spread risk matters. Managing credit spread risk isn't just for big-time investors or financial analysts. Even if you're just starting out, understanding this concept can help you make better investment choices. Think about it. Knowing the strength of the companies you invest in can help you avoid unexpected losses. Don't leave it to chance. Be proactive and take control of your investments by learning how to manage the risks involved. This way, you can protect your investments and work towards building a more secure financial future. Practical steps to take. Here are some practical steps you can take to manage credit spread risk effectively. Regular monitoring. Keep an eye on market indicators and credit spread movements to stay informed. Diversify. Don't put all your eggs in one basket. Spread your investments across different sectors and credit qualities. Stay educated. The financial landscape is ever-changing. Stay updated on economic conditions and credit ratings. Understanding and managing credit spread risk isn't just an advanced investment strategy, it's a fundamental aspect of making sound financial decisions. The more you know, the better prepared you'll be to handle market fluctuations and protect your investments. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.